Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thanks for joining me today for this series, Navigating This Crisis. And we're going to cover some very important market updates and information and strategy as of March 23rd at 3 p.m. So I did prepare a slide deck. I think this is the best way for us to communicate this information for you. So I'm going to share my screen and review this with you. So great. So let's jump in. So what we're going to talk about today is what is going on in the markets and what is a self-induced recession. We're also going to discuss what we anticipate moving forward. And will this be a V-shaped decline and recovery? And what is that? We're going to talk about strategies that have been enacted on already and what strategies will be executed on moving forward. And really, playing offense is very critical here. We'll also discuss the most dangerous words any investor could say, speak, or believe themselves. And then lastly, how we can help you out through these difficult times. So a self-induced recession. So, that's the scenario that we actually find ourselves in. And that's, in essence, what the federal and state and healthcare authorities and experts have decided, that it's better to shut down the many different businesses, to have people stay at home. And that, in essence, they knew that would create a self-induced recession. And that's exactly what we have going on right now. So they made the decision, which is the lesser of two evils, the spread of the virus, or to temporarily shut down some businesses. In Ohio, many businesses have had to close, such as, restaurants and other non-essential business. And as we've sent out previously at Fidato Wealth, we're considered an essential business. We're fully operational, maintaining normal business hours, and we're all working from home. We've already actually done about 10 to 15 or so virtual meetings for existing clients. So doing their annual progress meetings and things like that. So what is, I guess, what are some key factors that we're looking at and that other economists are looking at? And really, it all comes down to is decisions that policymakers and the government will make, namely in regards to stimulus. So there is no doubt that there's going to be stimulus packages that are geared towards American businesses and American families. So I had a chance to listen to an interview with Neil Kashkari, who is the president of the Federal Reserve Bank of Minneapolis, and he's actually from Akron, Ohio. He was actually the one in charge of the TARP program, the relief package and stimulus package that was trying to mitigate the effects of the 2008-2009 crisis. And he shared some of their learning points from that, was that they realized that they were being too selective on who they were providing stimulus to. That the biggest things that matter is that they give out the stimulus quickly and very widely and deeply. So that's one of the things that we could keep our eyes peeled on is, how fast is stimulus going to get in play? Will Congress come together and get a stimulus package that they can all agree upon that will be the best for the United States? So we definitely will need stimulus to handle this shutdown, if you will, of our economy, even if it's on a short-term basis. So it's very important to note, I do get research from various third parties, such as Morningstar, Vanguard, Goldman Sachs, Dimensional Funds, BlackRock, many different places. I will tell you, though, that I'm very selective on which economists I follow and that I followed over the years that I consider trustworthy. There are some economists that no matter what is going on, to be upfront with you, they're always having that doom and gloom report on the outlook. And again, just to be upfront, a lot of these economists will work for either an insurance company that benefits from scary times, or they typically will manage a bond fund. And obviously people flock to bonds when there's volatility with stocks. So again, I'm very selective there. When I review the research, I'm looking for consensus among trusted economists or investment analysts that we follow. So Vanguard does believe that this pain will be short-term and that we will experience a sharp rebound. So just yesterday, Vanguard said that given increased efforts to contain the spread of the coronavirus, we anticipate a sharp, but we hope short, contraction in the US economy, which likely has already entered into a recession this month. We expect, however, that this also can turn out to be among the shortest recessions in our history. Importantly, we assume that the need to significantly restrain activity, such as the closure of non-essential businesses, will dissipate by late in the second quarter. Under such a scenario, and with aggressive fiscal and monetary policy changes, we would foresee a rebound in growth in the third quarter to mark the end of this sharp yet short recession. So they just came out with that statement yesterday. That is also the consensus of other economists. So what is a V-shaped recovery? You may hear that on the news. And so what a V-shaped recovery here, if you see on my screen, it's a sharp decline followed by a sharp rebound. So that's what they're I guess predicting. You can say Vanguard is predicting it. That's what we're hoping for. This is a best case scenario. It's not necessarily obviously a guarantee, right? We don't know for sure. But Vanguard has even modeled out their original scenario, kind of scenario one before the coronavirus emergence, and then other scenarios, a deeper V, scenario two, and a more prolongated V for scenario three. Again, a V-shaped recovery, a sharp decline with a sharp rebound is our best case scenario. Again, there are no guarantees with that. We do have to see how the government responds. So what are some strategy options that I guess we could have taken? Let's start there, and then we're going to talk about what we actually did take as a strategy. So one strategy is to obviously move to cash in January or early February. But to do that, one is you need to have a crystal ball. And two, we do have a couple senators in question that may have traded on inside information. That's unknown at this point in time. We can't say that that's the case, but you know, we don't obviously have access to inside information. We would never trade on it, and we don't have a crystal ball. So obviously this is a global pandemic. So what is the real strategy that we're looking at here? So, and it's important to note that sticking to the plan does not mean or does not equal doing nothing. We must play offense, and that's really important. So let's define what that offense looks like. So just continuing to rebalance and buy into these dips is really important. We've done that 5 times so far. And Vanguard, and actually one of their recent videos, they stress that as well as an important thing to do. And I've also heard Morningstar say that recently. So again, all the parties that I would consider a trusted source, right? Rebalancing into the dips. Investment management is critical in making sure that someone is truly diversified. So diversification and asset allocation are critical. And as our clients know, we have 14 different positions in our portfolios. That's the level of diversification and asset allocation in the portfolios. And everyone has the right mix of stocks to bonds based upon their risk profile and what their comprehensive financial plan indicates is the right mix for our financial planning clients. So that's very important. It's also important to note that there's about 4 positions over the past 12 months that are still up, okay? And those are all bond funds in the bond part of the portfolio. So very important. Lately, we've seen several prospective clients that were sometimes in a couple positions or 5 mutual funds or 7 mutual funds. And this is really kind of exposing, either advisors that are not fiduciaries or who just take a cookie cutter approach. You can't do that in times like this. Does being really diversified and having a really good asset allocation plan, does that make this like going on vacation? Absolutely not, but it will help dramatically. It's also important to note that we've made adjustments to our bond portfolio in October of 2018 and November of 2018. That was done to make the bond portfolio more conservative. So we even invested in a fund that maintains the value of $1 and invests in short-term debt instruments, right? So a very conservative position. So there are some very conservative positions within that bond portfolio. Also in May of 2019, we made some important adjustments to our international holdings. So these were all done with the viewpoint of being conservative in case of volatility. So we view the bond portfolio as the ballast or protection against when there's volatility with stocks. And those adjustments prepped us for these events. So the other thing, again, sticking to the plan is important, but what is also very important is the preparation that we have helped our clients do and our clients have helped themselves do by making sure that they have an emergency account or a cushion account. That there should be 3 to 6 months of living expenses in those accounts. We always encourage business owners that we work with to maintain 6 to 12 months of operating expenses in an emergency account or having access to a line of credit. So that's very important. So having those emergency cushion accounts. Also too, managing your, how we manage distributions for our clients that are retired is really important. So obviously we help our clients determine, when they should claim Social Security, how to optimize that. And if they have a pension, how to optimize that. And then their investments. So we help them come up with an investment plan that is not only friendly for the level of risk that they would prefer, but is also distribution friendly and tax friendly. But one of the things that we do for our clients that are retired is that we move to cash once a year to cover all of their expenses for the next 12 months. Okay. So we've had several client meetings where people have called in to get a refresh on where they're at. And they already have cash, let's say, maybe for the next 8 months or for the next 9 months, still in their account in an FDIC insured position. And that's because their cash was previously freed up to handle their distributions for the next 12 months. So very important. That's very critical, especially in times like this. And when we have a client account where their cash starts to decline because they're taking distributions, we're going to be very intentional about freeing up that cash when it comes time for that, right? So what our hope is that there are some positions that are up or neutral. As I just mentioned, there's about 4 positions that are up or neutral over the past 12 months, even with the sharp declines that we've had, okay? Also important to consider making any adjustments. So perhaps there's some discretionary spending that you can hold off on, or perhaps there's a big purchase that you would like to make. Now, I will tell you, unless that money has already been moved to cash for a big purchase, you should defer and wait. So there could be some adjustments that you should make in your specific financial plan. And also, as you can see on the screen, having a comprehensive financial plan is really important. And that's, obviously something that we work on with all of our financial planning clients. And many of you have seen this before, but having that comprehensive financial plan that has all of your goals, all of your resources in the plan, in the background, knows inflation, taxes, life expectancy, all those sorts of things, And then it factors in 1,000 trial runs based upon a kind of a bell curve of probable outcomes. So it's kind of very statistical. And for this particular plan, they have a 99% probability of success, even after the recent declines. Their probability of success was still 99%. And so what does 99% mean? You can see any plan above 90% is in the confident zone, or I'm sorry, above confident zone. That means it's okay if you're ultra conservative with your planning. In this particular case, this client has been a client for quite some time. We've had a chance to work with them on a lot of different planning activities and priorities over the course of almost 10 years. And so their plan is very dialed in. They don't need to make any changes. If your probability of success is in the confident zone, but maybe in that 80% range or 75 to 80% range, that is a plan that we would say, okay, what can be changed in that plan temporarily until the markets rebound? We we always advise our clients to maintain a probability of success of 85% or more. Now, keep in mind, this planning tool is very robust. It's factoring in bad market conditions in those 1,000 trial runs to determine the probability of success. But in this particular case, we've told this client their probability of success was 99%. We told them that this is having no impact on them, their lifestyle. All right, so it's really important to focus on what you can control and what matters. So let's talk a little bit about what we're focusing on at Fidato Wealth. So priority one is always existing clients. So, in times like this, we do reprioritize, right? So what's our priorities right now? Number one is managing the money. So prior to the coronavirus volatility, we were quickly approaching about $250 million of assets that we've been entrusted with. Focus one, priority one is to manage that money. Number two, what to expect from us is these ongoing client communications, during these challenging times. We will be communicating with our clients on a regular basis. I'll be sending out these communications about on a weekly basis. So existing client calls and annual progress meetings, that's number 3 on this list. So we're handling any client calls. I'm happy to report that, and we're more than happy to take your phone call or to email us. We did send out a previous email that talked about the best way to reach out to us and to schedule a call, and we're more than happy to. I'm also happy to report that our phone call volume has been very light, and I think that's just due to the amount of education that we do up front and how we help our planning clients develop that comprehensive financial plan. And then annual progress meetings. So with annual progress meetings, our focus moving forward is a little bit different. And what our focus is when we're doing an annual progress meeting, again, is to focus on what is in place already to weather these very difficult times, to look at that plan and the probability of success, make sure that you're comfortable with it and everyone's comfortable with that, and then just consider any adjustments that should be enacted on. We had a recent progress meeting where the client said, Tony, we don't want to look at our portfolio overview report right now. We know that it's down. It's only going to make us feel terrible because it's down. Let's focus on what we already have in place that's going to help us get us through these times. And let's take a look at that financial plan and let's see what that probability of success is. And we were going to suggest the same thing. And once she said that, I said, okay, that's our focus with annual progress meeting forwards, is we're going to take that same approach. Number 4 is prospective client meetings. So I am going to maintain a couple of slots per week to handle anybody that really should look at to see if they are diversified, if they have the right asset allocation. Again, that is really important at this point in time. So I do want to maintain availability to handle that for people that might need our help. But again, focus one, priority one is our existing clients. So lastly, I have a note here that advanced planning priorities are being reprioritized. So this could be tax planning or risk protection planning or estate planning or other advanced planning items that we work on with our clients. So we're not abandoning it, but we are reprioritizing it, and we are going to push back some of those activities. So we have to focus on what matters the most, and that's managing the money and helping our clients make sure that their plan is on track, and help them in any way that we can with that. So very important note there too. All right, so what, as far as our clients, what should they be focusing on? So number one is sticking to that long-term plan and knowing that that means to not just do nothing, but to play offense in the way that we've already played offense for you. Stay up to date on videos and emails that I send out. I know these videos tend to run about 20 minutes long, but I get tremendous amount of feedback from our clients that it's really helpful. So please stay up to date. Number three, again, control what you can, focus on what matters, make any necessary adjustments. Number five is to stay calm. I think that's really important. It's really challenging right now because any news that you turn on, they're always talking about negative statistics. There's not much news out there that's focusing on the bright side of things that's happening, or the silver lining of things that could happen, right? And right now, there's all sorts of commercials to buy gold and all these, and the news, the financial news channels will have economists on that just happen to be, the economists for an insurance company, and they have their bias. So staying calm is really important. And the other thing is to avoid the most dangerous words anyone could say or think. And the most dangerous words that I've heard anyone say is, "This time it will be different." I think once you say that and believe that and start taking actions upon that, it's going to cost a lot of future financial security. So far in the history of our country, only thing that has been different is what has caused the crisis or the challenge. That is the only thing that's different, is what caused the crisis or the challenge at hand. What will not be different is that we will come out of this better than we were before. And again, so far in history, that's always been the case. And if that's not the case in the future, we have obviously bigger problems on our hand than portfolios and other things. But again, what I want to focus on is that we have always come through things. This brings people together, and they rally together to get through it and come out better than they were before. I've shown this slide before too, is we've had viral outbreaks before, okay? And we've had some really bad ones, right? We had some really bad ones that killed a lot more people that have passed away than the current virus. So we had, swine flu, SARS, Ebola. I mean, there's a lot of different things here. But what I want to, again, just reemphasize is how the market changed the 12 months prior from the onset of those epidemics. Okay. In all but 2 cases, the markets were up after 12 months. So that's important to note. Okay. We have been through this before. So this is another piece that's from Vanguard, and they put this out in regards to the 08-09 crisis. And it's the importance of sticking with your plan even when things get scary. So this portfolio shows how a $100,000 portfolio, it declined with 08-09, and then somebody that went to cash. Okay, at the end of 2014, their portfolio would have been $71,000. That would be a permanent lifestyle reduction that you could never, ever recuperate from. Or if you went to all bonds, how dangerous that would be. Again, at the end of 2014, the portfolio would be $90,000. So it never would have recovered. And this other portfolio is if it was 50% stocks and 50% bonds, which would be considered balanced or a moderate portfolio. So that portfolio would be $141,000. Okay. So your future will be different. So that's saying it will be different in the future. It will be different if someone makes a change to break discipline. So it's critical that not only do we stick to the plan, but again, play offense, rebalance into the dips. Again, what is happening when we rebalance into the dips? So we're accumulating more shares. So it's number of shares times share price equals the value for that holding. So what we have control of right now is how many shares are owned. So if we accumulate more stock shares in the stock mutual funds that have declined, once the price per share starts to rebound, that position value will recover quicker. So rebalancing has been shown through academic study. It reduces risk and it enhances returns. So very important. So the goal of this is to reduce the time that it takes for your portfolio to recover. Very important. So again, focus on what you can control, which is what matters to you, and where the things that you can't control and where those overlap is where you need to double down. So in conclusion, these are very difficult times, but we're going to get through this. This does take a lot of courage, and it requires relentless and unwavering discipline. And that's what we're going to follow all the way through this crisis. Again, I urge you to guard yourself from commercials or quote unquote economists that are biased or programs with agendas. Again, stick to your comprehensive plan. Just please know we're here for you if you need to talk. That's not a problem at all. We're happy if you just want somebody to talk to about your plan. We're happy to do so. So our promise, our goal is to help all those that we partner with make it through these challenging times and capitalize on this opportunity at hand. We fully intend to take advantage of this volatility so that our clients have the best chance of coming out of this better than before. That's our goal and 100% complete focus. And we're just not going to waver. We're going to see this through. So please take care of your family, take care of your loved ones, and do all that you can to stay well. Well, I'm going to just also review some additional slides I've reviewed in a previous video. For those of you that are going to drop off, again, thank you for watching. And I'm going to move forward and review these. So again, volatility is expected. We expect a 20% or more decline rather, on average about every 4 years, as you can see on the screen. Average length to recovery is just under a year, okay? And we don't know. This recovery could happen. It could be a sharp decline, sharp recovery. It could take longer. It could take shorter. But again, we know that sharp declines of 20% or more in any given year does happen. It's happened even very recently, beyond the coronavirus volatility. So market timing can be very costly. Why is that? If we just look at the S&P 500 over a 20-year period, and this is updated every year, and every year the results show the same thing, that if you stay fully invested, your capital will grow the most. And the challenge is that 6 of the best 10 days occurred within 2 weeks of the 10 worst days. So again, the best days happen often right after the worst days. And if you're not in those days, you lose out. Okay, this second bar here is that you're invested 20 years, but you just missed those 10 best days. It cuts your principal in half. So I don't know many people that can afford to get their principal cut in half and still sustain that lifestyle that they want for the long term. So again, that's why you can't get in and out of the market. So we do have recessions. They last on average 11 months. Okay, the S&P 500 rate of return during that period of time is only 3%. But look at how long the expansions last. They last on average 67 months, and the total return for the S&P 500 during that period of time is 117%. So let's look at a bull market. You can see they last on average 71 months, have a 263% total return. Look at the average bear market. So they last on average 14 months. And the total return during that period of time. Now, this is just the S&P 500, right? So what you're hoping for is that other positions in your portfolio are not down as much, or there are some bond positions that are hopefully up. But the S&P during that period of time was negative 33%. But this just gives you an idea. If there is a bear market, it's about a 14-month on average period of time. Again, you can see the bear markets on this chart, these teal lines, okay? Bull markets are much more prevalent and frequent than bear markets. So diversification and asset allocation. So very important. This is showing you how high quality bonds have showed resilience when stock markets are unsettled. So this is the aggregate bond market. This does not include junk bonds. So we do not invest in high yield or junk bonds for our clients. Those have a lot more risk associated with them. You can see what bonds did versus what the S&P 500 did during those correction periods. So what is the science behind diversification? It's what we call correlation. And that's a statistical measure of how two securities move in relationship to one another. Okay. So, and I've simplified this into just 5 asset classes, just for presentation purposes. There's, again, 14 different sub-asset classes that our clients are invested in, but this is just all US equities. This is international developed markets. So a 0.83 correlation means that 17% of the time, they're going to move in a random direction compared to one another. Emerging markets, about 25% of the time, they're going to move in a random direction. Real estate, about 44% of the time, real estate compared to US stocks will move in a random direction. And look at bonds. 97% of the time, bonds move in a random direction as compared to US stocks. And so these are kind of lines of 14 different asset classes over the past 12 months. And the point of this is that there are still positions that are up, and that's really important. Those are the positions that would be sold, excuse me, if needed, right? So we're going to closely look at what positions need to, when a client that's in retirement has a need to free up cash for the next 12 months, what positions are up that could be sold that are, hopefully up or neutral, or maybe just down a minor amount. But those are the things that we look at. And sometimes we even do things like, okay, well, maybe we want to free up cash for the next 6 months to give us even more of a window of time for things to rebound. Well, again, thank you very much for joining me today. Again, we're here for you if you have any questions, and I sure hope that this information is very useful for you. Thanks. Have a great day. Bye-bye.